Welcome back to the BD Daily Finance News Podcast for the 24th of November 2025. We've got a packed 20 minutes on markets, the economy, and investing. So let's dive straight in.
Today we're hitting 5 big stories. BHP walking away from Anglo American as a $60 billion rival deal looms. Fresh warnings about froth in AI and data centers. Revolut's new $75 billion valuation. The changing face of big tech leadership in markets. And Bitcoin hovering around $86,000 with a crisis of belief.
On the broader tape, U.S. equities are trying to grind higher into a holiday-shortened week, with tech leading gains, even as Bitcoin stays under pressure. Futures on the S&P 500 are modestly green, and we're still trading off the idea of a potential Fed rate cut in December that could reignite risk appetite.
And global risk sentiment is being nudged by macro headlines from Ukraine peace talks to shifting rate expectations in places like India, where the central bank has hinted their scope to cut in December. Against that backdrop, let's start with the mining drama that could reshape copper for the next decade.
The headline in mining: BHP has walked away from its pursuit of Anglo American after being rebuffed for a second time. That leaves the path clearer for an alternative merger that's been described as a roughly $60 billion combination, which would be one of the biggest mining deals in years.
What's really at stake is copper. BHP's new pitch had put future copper growth at the center. But by backing off, they're effectively conceding that their existing operations, plus organic projects, will have to carry that strategy. A $60 billion rival deal could consolidate a huge slice of global copper production at a time when electrification and EVs are expected to push demand up by 30–40% over the next decade.
For investors, this is a reminder that the real M&A action in commodities is gravitating toward future-facing metals, not just iron ore or coal. If a combined rival controls more Tier 1 copper assets, that could tighten supply and support prices, especially if peace prospects in Ukraine eventually ease some of the geopolitical premium in oil and gas instead.
It also raises regulatory and ESG questions. A mega miner with outsized copper exposure will face scrutiny over community impact, water use, and permitting, which can delay projects by years. Active investors might look at second-tier copper names or diversified miners that become potential targets if this $60 billion deal sets a valuation benchmark.
So if you're building a portfolio around the energy transition, today's takeaway is that copper supply is consolidating and the biggest players are thinking in decades, not quarters. Let's pivot from the rocks under our feet to the servers in the sky, because capital is pouring into AI infrastructure, and not everyone is comfortable with the pace.
KKR's Raj Agrawal put it bluntly. He's concerned about excess exuberance in data centers and artificial intelligence, and says the firm is being selective to mitigate risk. When someone overseeing tens of billions in infrastructure and credit says the AI build-out is looking frothy, that's a signal worth listening to.
We've seen estimates that AI-related data center capex could top $1 trillion globally over the next several years, with hyperscalers and chipmakers driving the charge. But Agrawal's point is that not every warehouse full of GPUs will earn its cost of capital, especially if power constraints, permitting, and competition squeeze returns.
Exactly, and that's where selectivity matters. KKR is signaling they're leaning into projects with long-term contracted demand, reliable power, and strong counterparties, and avoiding speculative builds. For equity investors, that suggests focusing on quality, profitable AI leaders, mission-critical infrastructure, and picks and shovels, rather than every stock with AI in the ticker.
It also dovetails with broader market chatter that we might be in an early 1999 phase, where fundamentals still justify much of the enthusiasm, but pockets of excess are starting to form. If the Fed does cut in December, that could add fuel. So hearing a big private markets player preach caution is a useful counterweight.
The practical move for listeners is to stress test your AI exposure. Ask, if revenue growth slows by a third, do these companies still look attractive? And on the credit side, remember that higher for longer rates mean leveraged AI bets can unwind quickly if cash flows disappoint. Let's stay in the growth lane but switch to Fintech, where valuations are also stretching.
Revolut has reportedly hit a $75 billion valuation in a new fundraise backed by Cochu, Nvidia, and Fidelity. That puts the UK-based neobank in the same valuation ballpark as some large European banks, despite still being privately held and, in many markets, relatively young.
To put that in context, a $75 billion price tag implies a very rich multiple on revenues for a company that started as a foreign exchange card less than a decade ago. The investor mix is telling. Coatue is a growth tech specialist, Nvidia brings the AI halo, and Fidelity is a traditional asset manager, so you're seeing both thematic and institutional capital validating the story.
What's interesting is how this contrasts with some listed fintechs that have seen their multiples compress since the 2021 peak. Private markets appear willing to pay up for scale, global reach, and the optionality of layering on new products, investing, crypto, credit inside one super app, even as public investors demand clear profitability.
For everyday investors who can't buy Revolut directly, the signal is that fintech disruption is far from over, and incumbents still face margin pressure on payments and retail banking. You might express that view through established payment networks, core banking tech providers, or diversified financials that partner with rather than fight the neobanks.
And it loops back to our AI discussion. When Nvidia shows up on a fintech cap table, it reinforces the narrative that data, personalization, and AI-powered risk models are central to the next phase of finance. Speaking of tech heavyweights, let's talk about whether the era of the Magnificent Seven is really over.
One strategist piece this week asked if it's finally game over for AI and big tech stocks, arguing that we're shifting from broad euphoria to more idiosyncratic trading. Citi, for example, has highlighted Nvidia, Microsoft, and Apple as the three names to watch most closely now that the Magnificent Seven aren't moving in lockstep.
The logic is that earnings per share revision's breadth still looks solid for the broader market, but leadership is narrowing. Nvidia remains the purest AI hardware play. Microsoft is the enterprise software and cloud conduit, and Apple is the consumer hardware and ecosystem anchor together. They still carry enormous weight in the S&P 500 and NASDAQ.
So is it game over? Probably not, but it is a more mature phase. Valuations for some names have reset, and we're seeing days where Bitcoin sells off, but tech still rallies, which suggests investors are differentiating between speculative and cash-generative growth. The key stat to watch is earnings. As long as these three keep delivering double-digit EPS growth, the bull case stays alive.
From a portfolio standpoint, that argues for trimming excess concentration but not abandoning the space. Use pullbacks to upgrade quality, own the balance sheets and moats, not just the story stocks. And keep an eye on how rate cut odds evolve into December, because lower discount rates disproportionately help long-duration tech cash flows.
Also, don't forget sector rotation. If peace prospects in Ukraine improve and energy prices stabilize, some capital could rotate from defense and energy winners back into cyclicals and quality growth. That's another reason not to anchor your whole equity thesis on a single AI narrative, even if Nvidia, Microsoft, and Apple remain core holdings.
Let's finish with crypto, because Bitcoin is trading around $86,000 and still can't catch a clean bid. Deutsche Bank analysts warned that fading investor belief may be one of the biggest obstacles now, dubbing it a kind of Tinkerbell effect, where the asset only flies as long as people clap hard enough.
That framing gets at a real tension. On one hand, Bitcoin has institutional support, listed ETFs, and a fixed supply schedule. On the other, its fair value is heavily narrative-driven, and when macro backdrops shift, say, if real yields stay elevated or risk appetite rotates into AI and equities, some holders start to question why they're still in a 70-80% volatility asset.
We've also seen that during the latest slide, broader tech actually shook off Bitcoin's weakness, with global equities rising, even as crypto slipped. That decoupling undercuts the old argument that Bitcoin is a leading risk barometer and suggests it's becoming more of a niche high-beta sleeve rather than the center of the risk universe.
For listeners, the message is position sizing and time horizon. If you believe in the long-term digital gold thesis, a small, diversified allocation you can hold through 50% drawdowns might make sense. But if you're trading headlines and sentiment, recognize that once belief wobbles, price can overshoot in both directions before it finds a new equilibrium.
And don't forget the opportunity cost. With cash still yielding north of 4% in many markets, and quality equities growing earnings, The bar for holding non-yielding, belief-driven assets is higher than it was when rates were at zero. That's why you're hearing more institutional desks talk about crypto as a tactical trade rather than a core holding.
The flip side is that if the Fed does cut in December and real yields compress, some of that sidelined capital could rush back into crypto, especially if ETF flows pick up. So keep an eye on rate expectations, ETF inflows, and on-chain activity. They're the three dials that tell you whether the Tinkerbell effect is fading or quietly rebuilding.
Let's quickly recap today's playbook. In commodities, BHP stepping away from Anglo leaves room for a $60 billion copper mega deal that could tighten long-term supply. In growth, KKR is flashing yellow on AI and data center froth, even as Nvidia, Microsoft, and Apple remain the three big tech pillars to watch.
In Fintech, Revolut's $75 billion valuation shows private capital is still willing to pay up for scale and optionality, while public markets demand profitability. And in crypto, Bitcoin around $86,000 is wrestling with that Deutsche Bank Tinkerbell effect, reminding us that belief and macro conditions matter as much as code.
Action items for you. Review your exposure to copper and energy transition plays. Stress test your AI and big tech holdings for slower growth and higher rates. And make sure any crypto allocation fits your risk tolerance and time horizon. Diversification across assets and time frames matters more than ever in a market driven by both policy and narratives.
If you enjoyed this breakdown, hit subscribe so you don't miss our next daily episode. And share this with a friend who keeps asking whether it's too late for AI, too early for copper, or too risky for Bitcoin. We've given them plenty to think about today.
You've been listening to the BD Daily Finance News Podcast for the 24th of November 2025. Thanks for spending part of your day with us. Stay informed, stay diversified, and we'll catch you on the next one.